What's up, guys? It's Joseph. Should you invest in real estate or stocks? Having experienced the benefits of both assets, I am comparing two great wealth building tools today. Depending on your financial situation, goals, and investment style, you may like real estate or stocks more. This video will walk through the assets themselves, the concept of leverage, investment returns and the risks, the capital and time required, liquidity, volatility, ownership, taxes, and inflation hedge. And I'll provide an ultimate checklist to help you decide which asset is better for you. To understand how money can be made in real estate and stocks, we need to first understand the assets themselves and leverage. The assets. Real estate represents ownership of the land and structure on the land. The land can produce goods like crops, livestock, or material in the cases of farmland, ranch, and timberland. The structure on the land provides services to support living and working activities in the case of residential and commercial properties. These goods and services provide revenues and profits. Real estate appreciates as land and construction costs rise. Stocks represent shares or small pieces of a company. A company generates sales and makes profits. Shareholders of the company are entitled to the profits. They either receive the profits as dividends or reinvest the profits back to grow the company. As the company grows, it becomes more valuable, and higher stock price reflects that growth. When you purchase a real estate property with 20% down payment and a loan of 80% of the property value, you are effectively 5 times levered. If the property rises 3%, the return on equity is 15% before financing expenses. Stocks involve leverage too. Instead of having a loan in your name, some companies you invest in can borrow money for the business itself. The leverage is on the company's books. Although you can go on margin to put leverage on your own books, your risk of insolvency or inability to pay the margin loan has increased. To meet margin requirement, you often sell stocks after prices had fallen. With a mortgage, lenders don't force you to come up with cash if your property value goes down and leverage goes up. But to borrow with real estate, you need personal income for residential properties and business income for commercial properties. The last thing I will say about leverage is collateral. Collateral is a physical asset or future profits pledged as security for repayment of a loan or to be forfeited in the event of default. For real estate, the collateral is the property. For stocks, the collateral is the company's future earnings. Return and risk. Stocks tend to have big gains and losses, but the returns average out to be around 9 to 10% annually. You can increase your stock return by taking advantage of a company's match to your contribution to retirement accounts or invest in possibly riskier or higher growth companies. On the other hand, direct real estate investments with leverage generate moderately positive returns that average out to be 11 to 12% annually. You can increase your real estate returns by keeping your leverage high. You can also try house hacking, flipping, or fixer-upper to boost your returns. Both real estate and stocks can experience large drawdowns and bankruptcy or catastrophic risks. You can get healthy returns in both real estate and stocks, as well as opportunities to make outsized gains. With volatility and the variety of stocks, you have more potential to multiply your investments, but higher risks of losing money. Real estate tends to be more stable, so you can engineer the levels of returns and risk. Now we've talked about the assets themselves. We're going to talk about how these investments work for you by discussing the capital and time required, liquidity, volatility, ownership, taxes, and inflation hedge. Capital. Stocks can be purchased in small pieces. Real estate takes more capital per deal. When you buy stocks, you buy a tiny piece of a company. For example, if a company is $100 billion in its market capitalization, but it has 1 billion shares outstanding, then each share is only $100. Now let's say a home costs about $300,000. 20% down payment on a $300,000 home would be $60,000. Even if you put down just 5%, it's still a substantial $15,000. Stock investing requires less capital to get started, so it's easier to build a diversified stock portfolio. Time. Real estate investing requires some knowledge and research to make the right purchase and financing decisions. Properties need to be actively managed and repaired. Rental properties require finding tenants and added management work. All these would take meaningful amount of time. Of course, all these could be outsourced at some cost. So real estate investing can be active or passive. Stock investing doesn't take as much time if you're just passively investing in diversified funds. But if you want to do better than the average, you have to spend time learning about the stock market and understand each company you invest in. For passive investors, both real estate and stock take less time but sacrifice returns on average. But for active investors, both real estate and stocks require more time. Liquidity and volatility. Real estate is illiquid and stocks are liquid. Because real estate has higher transaction costs, higher capital requirements, and each property is not standardized and unique, you have less buyers and sellers to participate in making a deal. Therefore, it takes longer to transact in real estate, and there are a lot of paperwork involved too. On the other hand, stocks can be bought or sold in small pieces with minimal transaction costs, and each share of a company is standardized, so you have more buyers and sellers or higher transaction volumes. It takes just a few seconds to transact in stocks. This dynamic creates more price volatility in stocks than in real estate, as real estate prices and transactions move slower and stock prices and transactions move very quickly. Sometimes the combination of price volatility and the liquidity creates emotions of panic selling when the stock market falls or the fear of missing out when the market rallies. Ownership. For many investors, real estate is appealing because it is tangible. You can touch and see it. That's because you have direct ownership of the asset. You are the CEO of the property. You have to make the decisions on the investment, finances, rents, and expenses. Ownership through stocks, on the other hand, can be indirect, because often you don't own enough shares of the company to have direct control. You leave the management to the CEO. With some stocks, you simply don't see the physical company or business. Taxes. Real estate is more tax efficient. You can write off depreciation and other expenses, and you only get taxed once at a personal level. You could also defer taxation on capital gain through a 1031 exchange when you sell and purchase a like-kind property. Stocks can be equally tax efficient, at least on the company's books. Companies can write off depreciation and other expenses too, but taxation happens twice, once on the company level and once at your level when you receive dividends or sell the stocks at a gain. Inflation hedge. Real estate is a good inflation hedge because property value and rents rise with inflation. I think stocks hedge against inflation as well, because as prices of goods and services rise, companies generate more revenues, hopefully more so than the increased costs. The earnings increase with inflation. So which one should you invest in? Both real estate and stocks are great wealth building assets. On average, I wouldn't say which one returns better than the other. I will do a deep dive on real estate and stock returns in another video. You can apply leverage to both real estate and stocks. It makes sense to diversify into both asset classes to take advantage of the different return and risk profiles. Stocks offer a diversified variety of businesses, while real estate is tangible. You can scale up in both real estate and stocks. Although real estate would require outsourcing and stocks would require more research and more monitoring. Stocks are definitely more liquid and volatile. Real estate is more tax efficient. Now, grab a piece of paper and pen. Make a check mark next to these statements and evaluate which asset is for you. Real estate is for you if you like tangible assets, can borrow easily with job income, like stable returns, have time to self-manage properties, don't need the liquidity, don't like volatility or drawdowns, trade too often than needed, like more control, want to save more on taxes. Stocks is for you if you enjoy researching companies, don't want leverage on your own books, like opportunities for outsized returns, have limited capital, need liquidity, okay with volatility and drawdowns, have discipline with trading, trust the CEOs to make decisions, don't like accounting and tax filings. That's it for this video. You should now have a basic but comprehensive understanding of real estate and stocks. I hope this video helps you decide which asset fits better in your portfolio. As always, please subscribe and like this video. Check out other resources on money and investing on my YouTube channel and website. There are a million different places you could be right now, but you're here. So thank you for stopping by. I hope to see you soon.